Okay, welcome. My name is Kyle, and this is going to be an e-tutorial on how to solve problem E11-15 from the Pearson workbook. So what we need to do is record the payroll deductions, and employer payroll costs given the following information about an Ontario company. So we have payroll information here, and then we have an additional piece of information down below that says, in addition to the RRSP deducted from the employee, the employer made a contribution of 1% of gross pay to the company pension plan on behalf of the employees. Okay, so just to start this, let's do a little bit of a reminder about the difference between gross pay and net pay. Gross pay, of course, is the employer's payroll cost, the salary expense or the wages expense, but net pay is different. Net pay equals gross pay minus deductions. So we have over here, I'll highlight them all in yellow, is a series of deductions to this employee. So their net pay, the cash that they're going to take home, their take-home pay is going to be their gross pay minus the sum of these deductions. So just to start this problem, I'm curious, I want to know how much cash this employee is going to take home. I'm going to calculate the net pay. So I'm going to just add together the total deductions. And the benefit of doing this in Excel, so total deductions, which means that this employee's net pay is going to equal the 190,000, the gross pay, minus the 48,545. So gross pay minus the deductions. And that's going to equal something. 141,455. Okay, so this is good. We're off to a good start. I'm just going to clean this up a little bit. I'm going to remember that this is net pay. I'll label it. And I'm going to erase this to give us a little bit more space to work with. So when doing the journal entry for this, the total employer cost of salaries is the gross pay. This is what they're paying to the employee. They withhold what's circled in here. The deductions are withheld. So that means the employee doesn't get it. The employee instead gets net pay. The employer acts as an agent to withhold this and remit it to where it needs to go. So they have a liability in order to pay each of these items. That's critical for us in really knowing how to do this journal entry. So to start this journal entry, I'm going to put March 31st. This is the date, and we're going to debit a salaries expense account for the employer. The total amount we're going to debit is the 190,000. That's the expense to the employer. Why is that the expense to the employer? Well, because all of these deductions are the employee's responsibility. Now, some of these are cost shared between the employer and the employee, yes, but the employer will have to contribute on top of what the employee is putting in. So the total salary expense is the gross pay to the employer. And then what we have is, well, a series of payables. These deductions are withheld from the employee, and the employer is going to remit them to where they need to go. So that means they're not paying them yet, but they will pay them later. So they have to set up a payable for each of these items. So I'm going to just go through this one by one, starting with income taxes. So employee income tax payable. I'm going to credit that because it's a liability. To increase the liability, I credit liabilities. CPP payable. Remember, CPP is Canada Pension Plan. 9,300. EI payable. Remember, EI is employment insurance. 3,500. RSP contribution payable. 10,000. Union dues payable. 2,945. Okay. So we're almost done with this problem. Just to demonstrate something, I'm going to sum up my debits, sum up my credits. It's not going to balance, but I want to show you something what will happen. So my total debits, of course, is 190,000, and my total credits is 39,545. The difference between these, if I were to deduct the credits from the debits, is going to be 150, and I've made a mistake somewhere. Let me just see what's going on. Oh, I see. RRSP contribution payable, 1,000 I have here, but in actuality, it should be $10,000. So sorry about that. Let me just add in another zero. Okay. So looking at this, the total debits minus the total credits is 141,455. Now that matches exactly the net pay, and that makes sense, right? So what we have to do is recognize another liability. The liability is going to be salaries payable. It's going to be 141,455, and now our journal entry balances, debits equal credits. Everyone's happy. Okay, so this is only one of what will be 3 journal entries in this problem. Why? Because we know that some of these deductions are cost shared between the employer and the employee. We know that CPP and EI are both cost shared. So whatever the employee contributes, the employer has to match at a factor. So there's benefits on top of this. But employee benefits expense. I'm going to put that as a placeholder for my debit. What are required to match is CPP, and CPP is at a ratio of 1 to 1, and then EI has to be matched, and it's 1.4 times what the employee puts in. So I'm going to set up more liabilities. CPP payable, EI payable. Now, if the CPP is matched at a factor of 1 to 1, and the employee contributed 9,300, the employer also has to contribute 9,300. So it's matched at a factor of 1 to 1. EI instead is matched at a factor of 1.4 times. So if the employee is putting in 3,500, that times 1.4 is going to equal something, $4,900. And that's what the employer is going to be contributing, which means that the total benefits expense is these two added together for a debit of $14,200. So these two would be added together as expenses on the income statement for this employer. Okay, we're almost done this problem. There's just one more journal entry. And the final one came from the additional information that we were given down below. The employer made a contribution of 1% of gross pay to the company pension plan on behalf of the employee. So this employer has a pension plan that they've established. They contribute to it on a regular basis. So this is another benefit that we have. So it's going to be a pension expense, and it's 1% of gross pay. So we know gross pay was 190,000 times 1%. It's going to be 1,900, and we'll put pension benefits payable. And we've completely solved this problem. Now, however, I do want to go a little bit beyond what the requirements of this problem were. Let me just go up and make sure that we've covered everything. Yes, okay. So we've contributed, or we've solved this problem to 100% completion, but let's pretend now pay date, whoops, I wanted to have a marker there. Let's pretend the pay date here. We made this journal entry, all of these were in March 31st. And likely the payroll would be sometime, the pay run would be sometime in early April. And they would do this to recognize the expenses in the proper period within March, the salary expenses on the income statement. But let's say the pay date was April 7th. That's when the employee is going to receive their net pay. So if the pay date is April 7th, the journal entry for that would be to reduce the salary payable to zero. Remember, the salary payable is 141,455. So they're going to reduce that to zero. And they're going to reduce their cash because they're actually going to be paying their employee on this date, April 7th. Now, this was just to illustrate what the journal entry would have been when the organization issues a check to the employee. They would debit their salary payable to reduce it to zero, credit cash to lower cash, and they actually are giving checks or directly depositing that amount into their employee's bank account. And they would do something similar when they were making the CPP, EI, remittances, and all of the other payables that they have set up. Likely that all of those would be issued on a quarterly basis. But that's E11-15 from the Pearson textbook. I hope that you found this tutorial useful. My name is Kyle. Have a great day.